take an example of a stock in the BFSI sector and show you how we analyze the stock from an education perspective. We will cover several parameters such as business model, management pedigree, competition, growth drivers, financial strength, and risks and concerns. Let us first give you a summary of these factors. Poonawalla Fincorp is an NBFC that focuses on products catering to consumers and small business finance, which promises to have a large opportunity in the future. The company has undergone a rapid transformation in its underlying fundamentals post the acquisition of its new promoter, Poonawalla. Post the acquisition, PFL or Poonawalla has healthy access to funds and has seen credit rating upgrades, strong leadership, realignment of the customer and product segments, and focus on leveraging technology analytics positions PFL to build scale and deliver superior risk-adjusted returns. The management has a long-term guidance of AUM growth of 35 to 40%, profit growth of 30 to 35%, gross NPA of 1.3 to 1.8%, net NPA of 0.5% to 0.9%, and return on asset of 4 to 4.5%. The company has set a vision for 2025 of becoming one of the top 3 NBFCs in consumer and MSME space, taking a risk-calibrated accelerated growth, reduce its costs of funds to the lowest in the industry, and have best-in-class asset quality. At current market price of Rs 290, the stock trades at a consensus analyst estimate of 2.1 times FY24 estimated book value per share, and the stock has come off its highs of Rs 343.75 and currently trades at Rs 290. Now let's understand the company a bit in detail. Poonawalla Fincorp is an NBFC that caters to the financial needs of consumer and small business finance. The gamut of products includes personal loans, loans to professionals, business loans, SME loans, loan against property, pre-owned car finance, medical equipment loans, and auto lease. As of Q3 FY23, unsecured professional, personal, and business loans contributed 68% to the disbursement mix and close to 43% to the standalone AUM. The company has initiated a direct digital program that has seen a consistent rise in contribution. It constitutes about 66% of its distribution as of Q3 FY23. With the recent change in the management, the access to the funds has increased multifold for the company, and it enjoys one of the lowest costs of borrowing amongst its peers. North Zone contributes 26% of AUM, East contributes 13%, South 30%, and West 31%. The company has undergone a rapid transformation post the acquisition of controlling stake by the new promoter Poonawalla. The company was renamed from erstwhile Magma Fincorp to Poonawalla Fincorp. Let's see some various transformative changes brought about by the management post the acquisition. The company now has access to a diversified liability or funding mix, which has risen multifold and solved the struggle to acquire access to funds during the pandemic. Further, the company's rating was upgraded by CARE and CRISIL. It enabled the company to engage with banks and got the interest rate on its bank term loans repriced downwards. The company now has access to one of the lowest incremental costs of borrowings amongst the group of NBFCs. Access to a strong pool of funds, reduced cost of borrowings, and a new promoter group have enabled the company to focus on select credit-tested customers who have high CIBIL scores. The company has targeted under-penetrated and targeted select pockets in urban India that are at the nascent stage. The decisive change in the thought process allowed the management to offer digitally enabled products, while products that require heavy cash collections were discontinued. PFL is shifting from an intermediary to a direct digital partnership model. In such a model, the credit and risk profile are determined by PFL, which has put stringent control on the first loan default guarantee arrangement. Except for loan against property or LAP, all other products would be offered under the DDP model. The model is aligned with PFL's target customer segment and has led to lower customer acquisition costs, reduced turnaround time, and customer delight. PFL modernized its existing software and platforms, strengthened its DNA through investments in technologies and analytics, and shifted to a cashless, paperless, and humanless digital model. It has built scalable infrastructure to process high volumes at high transaction speeds. Technology has become a competitive mode for the company. Various growth drivers across business segments will drive the company's future growth. These growth drivers are as follows. Pre-owned car market is expected to grow at a CAGR of 11% over the next 5 years on the back of a shift of market share towards organized players, new business models, changing customer preferences, reliable products and services, as well as increasing demand in Tier 2 and Tier 3 locations. PFL has gained a leadership position in pre-owned car financing on a monthly disbursement basis and plans to grow in the segment by 15 to 20% through FY25. Personal loans and business loans help to cross-sell other products. PFL has entered the space of digital loans through long-term partnerships and digitized end-to-end processes and introduced process-driven checks that will help to minimize probable defaults. The company intends to moderate turnaround time for business loans progressively and build direct engagement with customers following an aggressive marketing campaign. To address the opportunity of loan against property, PFL plans to offer longer and flexible loan tenures and address a range of property categories. PFL sees a big opportunity in leasing automobiles to corporates, as merely 5% of vehicles are leased in India. The industry is likely to report a CAGR of 20% in the medium term. PFL plans to deepen its footprint in the corporate sector for auto lease. PFL's standalone AUM has witnessed a 69% growth from Q2 FY22 to Q3 FY23. It grew by 28% year-on-year in the 9 months of FY23. The growth was driven by defocusing on discontinued products, constant reduction in turnaround time, strong growth in disbursals, which has witnessed 3.1 times growth since Q3 of FY22, backed by lean and agile back-end operations. AUM growth is estimated to grow at a CAGR of 35 to 40% over the long term. On a steady-state basis, management expects the NIIs to remain steady around 10%, as the company is able to raise incremental capital at competitive cost of borrowing. Cost of funds have reduced from 8% in Q3 FY23. It also allows PFL to cherry-pick better credit quality customers, offer them the best pricing, and generate healthy risk-adjusted returns. Further, it will benefit from its high-cost legacy borrowings maturing and upcoming products such as consumer durable finance and credit cards, which would generate better yields. In addition to better NIMs, improvement in cost ratios driven by operating leverage and provision write-backs have driven steady profitability. Profit after tax has grown at a strong pace since Q4 FY22 from Rs 89 crore to Rs 150 crore in Q3 FY23. The restructured book has been declining steadily, credit costs have remained benign, and asset quality is estimated by analysts to strengthen as legacy book runs off and newer origination delivers robust asset quality. The company has kept its gross NPA and net NPA stable sequentially. As of 9 months of FY23, its net NPA stands at 0.9% and provision coverage ratio stands at 47.5%. As per analysts' estimates, return on asset is expected to improve from 2.5% in FY22 to 4.8% by FY25. The key risks of investing in company involves the following factors: inability to execute on its articulated strategy, aggressive competition, post-seasoning of new loan disbursals on back of asset quality turning out to be inferior compared to expectation, which might elevate credit costs. Post-infusion of capital by promoter group, PFL has changed course and is on its way to build a franchise that can deliver strong growth across credit cycles and economic cycles. The company has access to low-cost funds and better credit rating, focus on products with huge addressable market, ability to leverage technology, will deliver loan growth and improve operational efficiencies. Sale of its housing finance business will lead to net worth accretion. At current market price of Rs 290, the stock trades at 2.1 times FY24 estimated book value. The stock has come off its highs from rupees 343.75 and currently trades at rupees 290. Kindly note, we do not give any recommendation or advice. Students who wish to learn further can do their analysis or consult a financial advisor. This is Veeru signing off. Happy investing.
This should not be treated as a recommendation. Please conduct your own analysis or consult a financial advisor before investing. Thank you.